So if consumption increased and then central bank did not respond, that means output increased. Now, if output increased, what happened with the dividend? Just think about company, any company, okay? When the economy was booming, increasing growth, what happened with the dividend? Goes up, right? Goes up, right? And then, if you go back to the ISLN, if Bank Indonesia did not respond, what happened with the interest rate? If Bank Indonesia did not respond, there's no change, right? The interest rate remain the same. So if this interest rate, if the denominator remains the same and the numerator goes up, what happened? Price goes up. So you don't need to go all the way to the productivity and so on, because that's an unknown. We don't know whether there is an increase of productivity or not. You know, and any economy can go up without improving productivity. The growth can go up without improving productivity, okay? So just always go back to the price equation here. So if the numerator goes up because dividend goes up, why? Because dividend is a function of output. This is the reasons why I emphasize the difference between bond price and stock price. In the case of bond price, there is nothing in the numerator that is connected to the GDP. There's nothing, because it's fixed number, which is 1,000 rupiah. I give it an example, right? But in the case of stock market, the numerator depends on the economy. So if the economy going up, then the dividend will go up. That means the numerator goes up. What about the denominator? Well, we are still talking about first scenario. Meaning what? Meaning Bank Indonesia did not respond, meaning the interest rate remained the same. So what happened if the interest rate, if the denominator is the same and the numerator goes up, what happened with the price? Goes up, right? Okay, see, I was reminded by the TA that time is almost up. So let's go quickly to the second scenario. Suppose now Bank Indonesia responded. And the response is raise the interest rate. Remember, the LM curve is shifted up. Now I'm afraid to move my slide here. So you have to look at your slide yourself, because if I move the slide, I'm afraid it will be frozen again. So what happened under the second scenario?
Sir, because when
yes,
the central bank do something like increase the interest rate, it will decrease the price in the stock market, since the numerator for price equation is interest.
Yeah, except that answer is correct, but you have to put comma, don't put period, comma, except if, for example, the dividend goes up, because remember, dividend is a function of GDP, okay? But it doesn't always mean that the dividend will not go up if the GDP did not go up, because GDP is only one of the factors that determine the dividend. Okay, so the correct answer, the 100% correct answer to the second scenario is undetermined. So again, if in the exam there's a question, what happened if the Bank Indonesia respond by raising the interest rate? The answer is undetermined, because it all depends on what happened with the dividend. Why we don't need to answer this way in the case of bonds market? Because in the bonds market it's clear, the numerator does not change. But in the stock market, the numerator changes. Now, what determines the change of the numerator? Among other things, not the only one, but among other things is the GDP. Okay? So, let me repeat. Under scenario 1, the price of the stock market will definitely go up. Under scenario 2, the price of the stock market depends on other factors that influence the size of the dividend. Okay? So, I hope you get the sense about this financial market. And in fact, there are other slides, but unfortunately time is up, so I cannot cover the other slide. The only thing that I want to leave you today is what is called the wealth effect. And this is so important. Let me go back to that, and then after this we can stop. I think I have somewhere above here, wealth effect. Where is it? Oh, I thought I had it. So Jana Posi, be patient, okay? Let me find 1 minute this.
No problem.
Okay, here we go. Okay, can you see this now? I hope it's not frozen. What do you see now? What slide are you seeing now?
Price and macro policy.
Okay, so look at the bottom here. This is the wealth effect here. Okay, so this should be familiar for you because this is output equals to consumption plus investment plus government spending plus export minus import. Everything else you're familiar with, maybe except for the investment, because that will be the topic after, not next week, because next week the group will teach about long term. But there will be a week when I'm going to teach about the investment. But let's assume this is just investment, forget about anything within the bracket here. But look at the consumption here. Before, what you know is consumption is only a function of disposable income, which is income minus tax, right? But now there is W. What is this W? That's wealth. Where is it coming from? From the stock. So if, let's say, you have a lot of stock, share, you bought the stock, okay? Then even though your income is not that high, but your wealth is high because you have stock. Your income is not high, your salary is not high, but your wealth is high. And if that is the case, your consumption is also high. So that is a one big sort of additional factor that you need to understand, and that distinguishes between macroeconomics without financial market and macroeconomics with financial market. Because if we are talking about macroeconomics without financial market, there is no W here, there is no wealth, because the source of this wealth mostly coming from financial market. So you can imagine if you neglect the financial market, your equation GDP here is underestimated because you don't have W here, right? Your consumption is only function of your income. And yet your consumption is not only function of income, but also functions of how much you have stock, which is your wealth here, okay? And why consumption is important? Because the largest percentage component of your GDP is in consumption. I think in the case of Indonesia, it's almost 60%. You can check later on. I think 50-something%. It's more than half, definitely, okay? In the case of the US, this is 72% of the GDP. So you can imagine this component is so important. So what happened? If the macroeconomics we are teaching to students neglect the financial market, that means there is no W. So that means this consumption role is very limited. So this is another sort of evidence that, you know, macroeconomics as we know so far, at least macroeconomics from most of the textbook that we learn, is not correct. It does not explain the real situation simply because they neglect the financial market. I'll stop here unless there are other questions here, and I guess the time is also up. Any question?
Hello. As we know that now the world is facing a coronavirus pandemic, and a lot of stocks are experiencing a sudden dramatic decline. what happened?
Yeah.
What would possibly happen to bonds if the stock market crashes?
Okay, then, okay, imagine if you have money, let's say you have $100, okay, and then suppose before coronavirus, you split your money $100 into bonds and stocks, okay? But now, because of the coronavirus, the stock market's down. What do?
Invest in bonds.
Okay, let's continue. Suppose everybody is following you. So everybody moved from stock to bonds. What happened with the yield of the bonds?
Increase. Karena price-nya di-increase, terus demand, karena demand-nya increase, price increase, yield-nya decrease.
What happened with the yield of?
Decrease.
If everybody moved, huh?
Decrease.
I'm sorry?
Decrease.
Decrease. That's exactly what happened now in the market. So that is exactly what happened. I thought I have, maybe I don't know. I have the chart, but I don't, hold on. No, I don't have it here. Okay, I have a chart showing that in the US, that's exactly what happened. So most of the players moved to the bonds market in such that the yield of the bonds has been sharply declined. Yeah, I don't have it here. I promise next week I'll show it. I have it somewhere in my machine, in my computer. Or you can also just Google it. You know, Google and type the bonds yield US Treasury, because in the case of US, the name of the government bonds is US Treasury. Type bonds yield of US Treasury. Or without bonds, just type yield of US Treasury. And see the latest trend. It's diving down, very much down. So that reflects all the investors are moving away from stock market, moving to the bonds market. So it's a supply demand. When there's a lot of demand, okay, of the bonds, price will go up. And today we learn from the class, price and yield is inversely related. So that means if the price of bonds increase, the yield of the bonds goes down, right? Does that answer your question?
Yes, sir. Thank you.
Okay. All right.
Sir, yeah,
Yes?
I would like to ask if we still have a spare time. I think you haven't
Sure, go ahead.
really covered the other theories on the yield curve, because we have two theories, right? But you only spoke about the expectation theory, but I
Yeah.
think we haven't covered about the liquidity preference theory. Can you give
Yeah.
an explanation, like a little bit of it?
Yeah, well, because we don't have time actually, but why don't, okay, rather than giving you only partial explanation, why don't we, I promise, the next time we meet, not next week, because next week is Teguh, but the next time we meet, I'll explain to that topic. Because I don't think it's good to explain only partially, because there's a long explanations there.
Okay.
Is that agreeable?
Okay. Thank
Okay.
you, sir.
All right. Okay, any other quick question? By the way, as you notice, there are many other materials actually which we cannot cover today from the materials that you had. So why don't you go through those materials which we didn't discuss, and if you have question, raise that question the next time we meet, okay?
Okay.
All right, if there's no more question, Jana and Pozi, floor is yours.
Okay, thank you, Prof.
All right,
We will have
Bye.
a worksheet. Thank you, Prof. Good evening.
okay, bye.